The Property Bulletin by London Property, the home of superprime.
In the heart of Notting Hill, a picturesque garden square tells an unusual story. Majestic three-storey homes line the streets, but many remain eerily unoccupied. The driveways are empty, windows shuttered, and the glow of security lights hints at absent owners. It started just before Christmas, and now it's getting emptier by the day, says a long-term resident. Of the 15 houses on her street, she believes only 3 are occupied. Similar stories echo across Kensington, Chelsea and Hampstead. London's superprime neighbourhoods are seeing a growing trend of luxury homes sitting vacant for most of the year. The reasons? Tax changes. Many wealthy homeowners, particularly foreign investors, are leaving London due to rising taxes. Britain saw a net loss of 10,800 millionaires last year, with many relocating to tax-friendly havens like Dubai, Switzerland and Portugal. Market stagnation. High-end properties are struggling to sell, often overpriced and languishing on the market. With no financial pressure to sell, owners hold out for unrealistic valuations. Seasonal living. Many ultra-wealthy residents split their time between multiple properties, treating London homes as occasional crash pads. Data from Action on Empty Homes reveals nearly 1 million homes in England are not lived in regularly. 256,061 properties have been empty for 6 months or more, the highest level since 2011. 279,870 homes are not primary residences, up 6.3% since 2023. The situation is unlikely to improve. With non-dom tax benefits ending next month, foreign wealth will face new UK inheritance tax rules, likely prompting further exits. Unrealistic pricing is another culprit behind empty homes. Many sellers refuse to budge on price, despite a slow market. Take Grosvenor Crescent Mews, a prestigious cobbled enclave near Buckingham Palace. Indian tea billionaire Rishi Setia and Queenie Singh listed their 4-storey home in November 2023 for £13 million, despite never having lived in it. A year later, with no buyers, the price has dropped to £10.99 million. Estate agent Paul Finch of Beecham Estates has seen similar cases in Knightsbridge and Belgravia, where homes needing upgrades are particularly slow to move. If they're coming from overseas, they just don't want the hassle of renovations, he says. For the ultra-rich, an empty home is a rounding error on a balance sheet. Many hold properties for years, refusing to drop prices until a buyer meets their demands. A £14 million home in Belgravia has been sitting vacant since 2017, bought by a Turkish family for their son's university years. They later purchased him a flat for £10 million elsewhere, leaving the original home to gather dust. Now they're asking £20 million, a price unlikely to attract serious buyers. Despite their owner's absence, these mansions don't sit idle. A hidden workforce keeps them pristine. Luxury property management firms provide vacant care services, ensuring homes are ready for their owners' occasional visits. Staff handle cleaning, maintenance, heating and security checks, preventing void damage and deterring burglars. Some owners pay thousands per month to maintain properties they rarely visit. Even if properties aren't lived in, they still cost a fortune to maintain. Live-in housekeepers earn £17,000 to £22,000 a year, while premium management services charge £120 per hour to keep homes running. Security concerns are another factor affecting wealthy homeowners. Some international buyers feel London is less safe than before. People are scared to wear their jewellery, their watches, says George Azar, CEO of Sotheby's International Realty. When wealthy families visit in summer, they bring security with them. That tells you something's wrong. Yet for many of the ultra-wealthy, holding on to a £20 million empty home is just a waiting game. If you're worth £1 billion, what's another £20 million sitting there, says Finch. The superprime property market represents a paradox. London wants the wealth, but not the ghost town effect. Foreign buyers keep the market afloat, but their absence leaves neighbourhoods lifeless. It's a long-standing dilemma, how to balance global wealth with the need for a vibrant lived-in city. For now, London's most prestigious postcodes remain dotted with empty mansions and silent streets, monuments to a luxury market in limbo. London's once unbeatable property premium has all but disappeared. If you thought selling a flat in the capital would easily fund an upgrade to a house in the suburbs, think again, because the price gap has never been wider. For growing families hoping to upsize, the challenge is greater than ever. The price difference between detached houses and flats in England is at its highest level since 1998. In fact, moving from a London flat to a terraced or semi-detached house has never been more difficult. And yet London isn't the problem. Instead, it's the surge of city dwellers relocating to the commuter belt, a trend that exploded during the pandemic. This has pushed house prices in the southeast to unprecedented levels, with detached homes now selling for 50% more than the average London flat. For many, the numbers simply don't add up. Selling a £450,000 flat in London won't get you anywhere near the £1.5 million price tag of a detached house in Surrey's Elmbridge borough, which includes Esher and Cobham. That price gap, 3.4 times larger, has made upsizing a near impossible dream for many London homeowners. And it's not just Surrey. Across the southeast, detached home prices have surged by 44% over the past decade, while London flats have barely moved, rising just 17%, the slowest growth of any English region. Stamp duty hikes and tougher buy-to-let regulations have kept prices down in the capital, while demand for suburban homes has soared. So what's driving this shift? It comes down to supply and demand. For decades, young professionals in their 20s bought flats in London, then moved to houses with gardens in their 30s and 40s. But the pandemic changed everything. Office for National Statistics data shows that between 2015 and 2019, an average of 45,000 people left London for the surrounding regions each year. But when lockdowns hit, that number exploded, with nearly 80,000 people relocating in 2021 alone. And where were they heading? Almost two-thirds settled in the southeast, fueling house price inflation and making the step up from a London flat even harder. In Buckinghamshire, for example, the net migration of people in their 30s and 40s hit record highs in 2021, adding nearly 4,000 new residents in a single year. At the same time, first-time buyers started skipping flats altogether. According to Zoopla's Richard Donnell, 75% of first-time buyers in the southeast now want houses, specifically affordable three-bedroom homes. But here's the problem. There simply aren't enough houses available. Lucian Cook from Savills explains why. Older homeowners are living longer and not downsizing as often. That limits supply, making it even harder for families trying to upsize. And new construction? That's not helping either. Only 71% of newly built homes in the southeast last year were houses, the lowest level in a decade. Every other region is building more houses and fewer flats, but in the southeast, supply simply isn't keeping up with demand. What's the impact? Competition for family homes has never been fiercer, and prices have continued to rise. In fact, for every new house built in the southeast between 2020 and 2023, 2.3 people moved to the area, the highest ratio in the country. That mismatch has driven up prices, forcing many buyers to either stay put or move even further out. And the latest data from Hamptons confirms it. London has accounted for just 5.7% of all home purchases outside the capital in 2024, the lowest share in a decade, down from a peak of 8.2% in 2022. So what's next? Anisha Beveridge from Hampton sums it up well. London homeowners haven't had the housing market on their side in recent years. Rising interest rates, post-pandemic trends and slower price growth in the capital have all weighed on their ability to move. With house prices elsewhere rising much faster, many have simply chosen to stay put, or look even further beyond the commuter belt to get more for their money. For now, the days of trading up from a London flat to a suburban family home are fading fast. Unless London prices rebound or southeast supply improves, many homeowners may find themselves locked out of the next step on the ladder. London's housing delivery appears to be turning a corner. After hitting a low in 2022 and 2023, the number of homes submitted for planning in 2024 saw an encouraging rebound. A key factor in this recovery has been the growing appetite for operational real estate, particularly purpose-built student accommodation, PBSA, and co-living developments. These alternative housing models have gained traction as traditional private-for-sale housing faces increasing viability challenges. Developers have been turning to PBSA and co-living as more financially viable alternatives, given the rising costs of construction and softening values in the new build market. Demand for both sectors far outweighs supply, making them attractive investment opportunities. To account for housing delivery, national planning guidance applies conversion ratios. 2.5 PBSA beds equals one home. 1.8 co-living units equals one home. The pipeline for both PBSA and co-living has expanded significantly in recent years. In 2024 alone, nearly 20,000 PBSA beds and 7,500 co-living units were submitted for planning across London. Between 2022 and 2024, the annual average was 14,000 PBSA beds and 3,900 co-living units, equating to approximately 24% of total housing delivery when converted using the planning ratios. This is a major jump from just 4% between 2014 and 2019. This surge reflects the widening gap between supply and demand, which has strengthened viability for developers. Rents continue to rise, and occupier demand is growing, making PBSA and co-living increasingly attractive. While these developments cater to a specific demographic, their expansion has wider benefits for London's housing market. By accommodating students and young professionals, PBSA and co-living free up space in the private rental sector, alleviating some of the pressure on mainstream housing. With falling interest rates and stabilising construction costs, London may be entering a new phase of development. If market confidence continues to improve, and with greater political and economic stability, we could see a resurgence in private sales and build-to-rent schemes. As conditions become more predictable, the question remains, will developers once again shift focus back to traditional housing models, or will operational real estate continue to lead the way? One thing's clear, London's housing market is evolving, and planning applications are starting to reflect this new era of development. The UK government is officially moving forward with the introduction of reserved investor funds, RIFs, a new tax-efficient real estate investment structure. On the 19th of March 2025, the Co-Ownership Contractual Schemes Tax Regulations 2025 will come into force, providing the legal and tax framework needed to establish and operate RIFs under UK law. A Reserved Investor Fund, RIF, is a UK-domiciled, unauthorised collective investment vehicle, designed primarily for institutional and professional investors. It offers a flexible, tax-efficient way to invest in UK real estate while encouraging a level playing field between UK and offshore funds. A key feature of RIFs is secondary trading, allowing investors to buy and sell units without triggering stamp taxes, including stamp duty land tax, SDLT. This addresses a major issue dating back to 2004, when SDLT was imposed on secondary trading in UK-based limited partnerships, prompting many investors to shift their fund structures offshore. The RIF model is closely aligned with successful international fund structures, such as Luxembourg's Reserved Alternative Investment Fund, Ireland's Qualifying Investor Alternative Investment Fund, and Guernsey and Jersey private funds. By removing tax disadvantages, the UK aims to retain and attract more real estate investment funds within its jurisdiction. RIFs are targeted at institutional and professional investors, including UK and overseas pension funds, insurance companies, sovereign wealth funds, charities and investment trusts, banks, asset managers, large corporations, family offices and high net worth individuals. Who cannot invest in an RIF? Retail investors, everyday individuals are not eligible to invest in RIFs, and non-professional individuals unless they qualify under high net worth or sophisticated investor exemptions. They cannot participate. RIFs provide several significant tax benefits, making them highly attractive for investors. Income tax. RIFs are tax transparent, meaning income is taxed directly in the hands of investors at their respective tax rates, rather than at the fund level. Capital gains tax, CGT. RIFs are treated as opaque for CGT purposes, meaning the fund itself is not taxed on the disposal of its assets. Investors pay CGT only when selling their units in the RIF. Stamp duty land tax, SDLT. Transfers of units in an RIF are exempt from stamp duty land tax, although the fund must still pay SDLT on direct property acquisitions, unless it qualifies for seeding relief, which allows properties to be contributed tax-free. Capital allowances. RIFs benefit from simplified capital allowance administration, allowing pooled allowances at the fund level to be flexibly allocated to investors through their share of taxable profits. With the UK government officially backing reserved investor funds, this new structure could reshape the UK real estate investment landscape, making it more competitive with international markets. As the regulations take effect, investors and fund managers must stay ahead of compliance requirements to fully leverage the tax advantages and flexibility RIFs offer. Wealthy US nationals are increasingly turning to London's property market as a safe haven, with many citing political uncertainty in the United States as a key motivation. One major factor fueling this trend, the strength of the US dollar. American buyers purchasing property in prime London locations have effectively received a 38% discount thanks to favourable exchange rates. The dollar's strong position against the British pound has made high-end real estate in the UK capital significantly more attractive to US investors. Over the past year, estate agents have reported a surge in interest from wealthy Americans looking to secure properties in London's most sought-after neighbourhoods, including Mayfair, Kensington and Chelsea. For many, the decision is about more than just financial opportunity. It's also about seeking stability abroad. With Donald Trump's return to the White House, some high-net-worth individuals are looking to diversify their assets and secure a foothold in a market that offers both prestige and security. Industry experts say the trend is likely to continue as long as political uncertainty remains high in the US and the dollar maintains its strength against the pound. For now, London's luxury property market is reaping the benefits, with American buyers playing an increasingly influential role in shaping demand at the top end of the market.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.